This is Meet Sean, where we break down real life topics insurance, annuities, real estate, travel planning, and home ownership so you can make smarter moves. Subscribe so you don't miss the next episode.
I was looking at a psychological profile of entrepreneurs the other day, and it confirms something I think we've all suspected. The typical business owner is a bit of a control freak.
A bit. That's putting it mildly.
Right. I mean, think about it. If you own a business, you're obsessed with planning. You're up at 2 in the morning stress testing your supply chain.
Oh, yeah.
You're mapping out quarterly goals 3 years in advance. You're watching interest rates like a hawk. You're constantly trying to predict the future so you can control it.
It's really the nature of the beast. If you aren't looking ahead, you're usually getting run over by whatever's coming up behind you.
Exactly. But here's the irony that really struck me while we were prepping for this deep dive. There is one massive, glaring, catastrophic risk that so many of these hyper-prepared Type A founders completely ignore, and honestly.
Yeah.
I think it's because it's the one variable they actually can't control.
You're talking about the bus factor.
The bus factor. The grim reality of what happens if I step off the curb tomorrow and get hit by a bus. Does the business just crumble? Does the family go bankrupt trying to save it? It's uncomfortable, it's dark, so people they don't look at it.
It's the elephant in the boardroom. And it's a dangerous blind spot because the stats on business survival after an owner's death are not great.
So today, we are forcing that uncomfortable conversation. We're doing a deep dive into a guide called Life Insurance for Business Owners, the backup plan your company needs, from SeanWillInsure.net. And before anyone tunes out thinking this is just about personal finance,
I'm going to stop you right there because that is the number one misconception. When most people hear life insurance, they picture a kitchen table conversation about paying off the mortgage so the spouse doesn't lose the house.
right, making sure there's money for groceries and, college tuition.
And that stuff is important, but that's personal planning. What we're looking at today is life insurance as a strategic, operational business tool. We're talking liquidity, leverage, legal continuity, and, well, essentially how to keep the machine running when the operator is gone.
It's not just about leaving money behind. It's about operational survival. So let's start with that big picture. The source calls it the backup plan. But when we talk about business continuity, what does that actually look like in the chaotic days after an owner dies?
Well, strip away the emotion for a second, which is hard to do, but you have to, and just look at the mechanics. A business is a fragile ecosystem. You have vendors who need to be paid, creditors who are watching your cash flow, payroll that hits every 2 weeks.
Hit clients who get nervous really easily.
Very easily. And usually the owner is the glue holding all that together. They have the relationship.
They have the vision.
They have the relationships, the vision, and crucially, they often have the bank signature.
That's a detail I hadn't even thought about. So the owner dies, and suddenly the bank accounts are frozen. Is that possible?
Potentially, yeah. Or lines of credit get paused because the guarantor is gone. This is the immediate liquidity problem. The source argues that life insurance provides an instant injection of cash to stabilize that whole ecosystem. It stops a liquidity crisis from becoming an insolvency crisis.
So it's basically buying time.
Exactly. It buys the remaining leadership team or the family maybe 12 to 24 months of breathing room. It lets them figure out, okay, do we sell? Do we hire a new CEO? Do we liquidate assets? Without that cash, you don't get the luxury of making a choice.
The market makes the choice for you.
And it's usually a fire sale.
And nobody wants their life's work to end in a fire sale. The source touches on this emotional side, the whole legacy aspect. And I think this is interesting because legacy can sound a bit ego-driven, but in a business context, it's really just about asset preservation, isn't it?
It is. I mean, think about the sheer number of hours a founder puts in, decades of work. If that business collapses 3 months after the founder dies just because there wasn't cash to keep the lights on, that entire asset, the value of that life's work, it just goes to zero.
Yeah.
Protecting the legacy is really about making sure that the equity value survives for the heirs.
Speaking of heirs, let's talk about the intersection of family and business. The guide mentions personal guarantees. I think a lot of people assume the corporate veil protects their family from business debts.
Oh, that is a dangerous, dangerous assumption.
Why is that?
Because in the real world of small to mid-sized business, banks aren't lending to the entity, they're lending to the person. So many business loans require the owner to sign a personal guarantee. That means if the owner dies and the business defaults, because it can't operate, the bank can, and they will come after the owner's personal estate.
So the grieving spouse isn't just dealing with the funeral and the loss. They're dealing with the bank foreclosing on the house to pay for the business's inventory.
That's the nightmare scenario, and it happens. Life insurance for the business acts like a firewall. The death benefit pays off the business debt immediately, so the personal estate is untouched. It unblurs those lines between family money and company money.
That distinction is so critical. Now, here's an angle from the source I hadn't really connected, and it was a bit of an aha moment for me. Employee retention.
Yes, this is huge.
We usually think of insurance as an owner benefit.
Yeah.
But how does the owner having a policy help the random guy in accounting or the sales team?
Okay, put yourself in that employee's shoes for a second. Let's say you're the VP of sales or you're a lead developer. You know the owner is the rainmaker. They're the heart and soul of the place. If that owner dies on a Sunday, what is your first thought Monday morning?
Is my paycheck going to clear on Friday?
Precisely. And is this ship going down? Do I need to update my LinkedIn profile right now? Uncertainty breeds panic, and panic creates a talent exodus. If your key staff leaves right when you need them most, during the transition, the business is finished.
So it's a confidence game.
It's all psychological, 100%. If the key staff knows there's a funded continuity plan, if they know, hey, if something happens to the boss, there's a $2 million policy that covers payroll and operations for 2 years, that fear just evaporates. They stay put, they help with the transition because they know their mortgages are safe.
That's a great insight. It's invisible glue for the culture during a crisis.
Yeah.
Okay, so that's the why, that's the philosophy. Let's open up the toolbox. The source gets into specific mechanisms, and the first one is key person insurance. Now, is this just a fancy term for a standard policy?
The structure is different. In personal insurance, you insure yourself to protect your family. In key person insurance, the company buys a policy on a specific human being. The company pays the premiums, and this is the important part, the company is the beneficiary.
So if that person dies, the company gets the check. Who is this for? Is it just the owner?
It can be the owner, but it's often a top employee. Let's say you run a specialized manufacturing firm, and you have one engineer who understands the proprietary machinery. Or you run an ad agency, and you have one creative director who holds the relationships with your 3 biggest clients.
Rainmaker. Or the wizard.
Right. If the wizard is gone, revenue might drop 40, 50, 60% overnight. But your expenses, rent, salaries, software licenses, those stay exactly the same. You are just bleeding out.
So the insurance payout is a bridge.
It does 2 specific things. First, it covers the financial loss from the disruption. It replaces that lost revenue so you don't go into the red. And second, and this is where people underestimate the cost, it pays for the recruitment.
Right, because you can't just put up a Craigslist ad for a replacement.
No. Replacing a unicorn employee is expensive. You've got headhunter fees, which can be 30% of the salary. You have signing bonuses. You have the cost of training time. And you have the opportunity cost, all the deals you lose while that seat is empty for 6 months. The policy covers all of that.
It turns a catastrophe into a budget line item.
That's a perfect way to put it. Instead of a crisis, it's just an expense that has already been paid for.
Okay, the next tool in the box is the one that I think is the most dramatic and, frankly, the most necessary. The buy-sell agreement. I've heard this described as a prenup for business partners.
That is exactly what it is. And frankly, if you have a partner and you don't have a funded buy-sell agreement, you are playing Russian roulette with your business.
Okay, walk us through the scenario. Because I think people assume my partner is my friend, we'll figure it out. Let's say you and I are 50-50 partners. Everything's great. Then, tragically, I die. What happens to my shares?
Well, without an agreement, your shares are just property, like your car or your house. They pass to your estate. So now my new business partner isn't you. It's your spouse or your kids.
And my spouse might be a wonderful person,
Yeah.
but they might know absolutely nothing about running a logistics company.
Right. Or worse, they think they know how to run it. Suddenly, I'm in board meetings with someone who wants to change the entire strategy. Or maybe they just want the cash. They might want to sell your half of the business to a competitor just to get a quick payout.
So you, the surviving partner, are just stuck in a nightmare. You can't make decisions, you're bleeding cash, and you have a partner you didn't choose.
A total nightmare. Friction, lawsuits, paralysis. I've seen profitable businesses fall apart in a year because of this exact scenario.
So how does the buy-sell fix it?
We sign a contract today, right now, it says. If host dies, expert must buy his shares and host's spouse must sell them. It sets the terms and, importantly, the price in advance.
Okay, that sounds good on paper.
Yeah.
But if the business is worth $10 million, my half is $5 million. Do you have $5 million just sitting in your checking account to buy out my spouse?
Definitely not. And that's the trap. The contract is useless if you can't fund it. You'd have to sell the business just to pay my family, which defeats the whole purpose.
Enter the life insurance.
Exactly. The business buys a policy on both of us. If you die, the business gets $5 million, tax-free, immediately. They hand that check to your spouse. Your spouse walks away happy with fair market value in cash, which is usually what they want anyway. I get 100% control of the company. No debt, no fighting, no new partners.
That is incredibly elegant. It solves the liquidity problem for my family and the control problem for you all at once.
It really is the silver bullet for partnerships. It keeps the business in the hands of the people who know how to run it.
The source mentions one more strategic use, securing loans. We talked about personal guarantees, but this is a bit different.
Yeah, this is about collateral assignment. If you go to a bank for a major expansion loan, say $5 million to build a new factory, the bank looks at the risk. If you are the key driver of the business, your death is a massive risk of default for them.
So they won't lend the money.
Or they'll charge you a crazy interest rate. Unless you have insurance. You can assign a life insurance policy to the bank as collateral. If you die, the bank gets paid off first, automatically. It lowers their risk to zero on that front, which means you get approved and you often get much better terms.
So in that case, the insurance isn't just protection, it's actually a lever for growth. You literally can't get the capital without it.
Spot on. It unlocks capital.
Okay, so we know why we need it. Let's look at the menu. The source breaks down the specific product types. And I want to be careful here because eyes tend to glaze over when we say things like universal variable life. Let's just keep it to the concepts. We have term, whole, and universal.
Right. Think of it as a spectrum of renting versus owning.
Okay, start with term. That's the renting.
Yes. Term life is pure insurance. You pay a premium for a set period, 10, 15, 20 years. If you die in that window, it pays out. If you live past the window, the policy expires and you get nothing back.
It feels a bit like throwing money away if you survive, doesn't it?
Well, do you feel like you threw money away on car insurance if you didn't crash your car this year?
Fair point. It's paying for risk transfer.
And because there's no investment component, it is dirt cheap. The source emphasizes this is best for temporary liabilities. If you have a 10-year bank loan, get a 10-year term policy to cover it. If you plan to retire in 15 years, get a 15-year term for the buy-sell agreement. It's really efficient.
Okay, moving to owning. That's whole life.
Whole life is permanent. As long as you pay the premiums, it creates a death benefit when you die, whether that's tomorrow or when you're 99. But the key feature here is cash value.
This is the equity part.
Right. A portion of your premium goes into a savings account inside the policy. It grows over time. It's an asset on your balance sheet. The company can borrow against it or use it as a reserve fund.
But the premiums are significantly higher.
Much higher. You're paying for the insurance and the investment and the administrative costs. The source suggests this is a long-term play. It's for legacy planning or if you want a conservative place to park corporate cash that also provides a death benefit.
Then we have the hybrid. Universal life.
Universal life is the adjustable wrench of the group. It's permanent, but it's flexible. You can often adjust how much premium you pay in a given year, or even adjust the death benefit amount up or down as the business changes.
That sounds ideal for a business where cash flow might be, lumpy.
It is, but it comes with complexity. The cash value growth is often tied to interest rates or market indexes. If the market tanks, your policy performance might suffer. The source warns that you really need to understand what you're buying here. It's not set it and forget it.
Let's get into the weeds a bit, the financial nitty-gritty. Because if there's one thing business owners care about more than growth, it's taxes.
Always.
The source mentions a tax-free death benefit. In the U.S. tax code, that phrase is pretty rare. Is it really tax-free?
Generally, yes. This is one of the most powerful aspects of this tool. Under Section 101A of the tax code, life insurance proceeds are not considered gross income. So if the policy pays out $2 million, the company gets $2 million, not $2 million minus 35%.
That is huge for crisis management. You get 100 cents on the dollar when you need it most.
But, and there's always a but with the IRS, you have to be careful with the premiums.
Can I deduct the premiums as a business expense?
Usually no. This is where people get tripped up. If the business is the beneficiary, meaning the business keeps the money, like in key person or buy-sell scenarios, The premiums are not tax deductible. You pay with after-tax dollars.
So the government says you can't deduct the cost, but we won't tax the payout.
Exactly. And honestly, that's a trade-off you want. You want the big check at the end to be tax-free. There are some exceptions, but for the key person and buy-sell stuff we're talking about, just assume no deduction.
Okay, that's a clear distinction. Now, the million-dollar question, literally. How much insurance do you need? You can't just lick your finger and put it in the wind.
No, and underinsuring is almost as bad as not insuring at all. The source outlines a valuation framework. They list 3 main factors to calculate your number.
First one is business value.
Right. This is for the buy-sell. You need to know what the company is actually worth. Tangible assets plus intangible value, like brand and IP. If you promise to buy your partner out for fair market value, you need to know what that value is to insure it.
Second is key personnel cost. And this isn't just their salary, right? We touched on this.
No, it's the replacement cost.
Yeah.
Headhunter fees, signing bonus, training, plus, and this is the hard number to calculate, the revenue impact.
Yeah.
If that salesperson brings in $2 million a year and it takes you a year to replace them, you need $2 million of coverage just to break even.
Wow, that number could be massive.
It's often 2 or 3 times their annual revenue contribution.
And the third factor is liabilities.
Simple debt clearance. Add up the loans, the lines of credit, the equipment leases. You want to wipe the slate clean so the surviving business isn't strangled by debt payments while revenue is down.
So you add up the buyout price, the replacement cost, and the debt load. That's your number.
And don't be shocked when that number is big. It reflects the value you've built.
We're heading into the home stretch here. If this is all so logical, protecting the asset, tax-free liquidity, why doesn't every business owner do it?
The source lists some myths that hold people back.
The big one is always cost. I'm bootstrapping. I can't afford premiums.
But we established term is cheap.
It is. For a healthy 40-year-old, a $1 million term policy might cost less than the office coffee budget. It's a negligible line item relative to the protection it offers. The ROI on that, if the worst happens, is infinite.
The other myth is I'm too small. This is for Coke and Pepsi, not for my 10-person shop. The source argues the opposite, and I agree 100%. If Apple loses a VP, they have a bench of 50 people ready to step up and $100 billion in cash reserves. They're robust. If a small business loses the owner, they're fragile. They don't have the cash reserves. The smaller you are, the higher the risk of total collapse. You need this more than the giants.
That's a really powerful reframing. Vulnerability scales inversely with size. So for the listener who's thinking, okay, you convinced me, I need to get on this, what does the process look like? Is this an online click and buy thing?
Definitely not. This isn't like buying car insurance. This involves financial underwriting. You'll sit with an agent, you'll fill out a detailed application, and yes, you will probably have to get a medical exam.
The dreaded fluid draw.
It's pretty much unavoidable for large policies. They're insuring your life. They need to know you weren't about to drop dead next week. They'll check your blood pressure, cholesterol, family history.
And financial documentation.
You have to prove the insurable interest. You can't just insure your partner for $50 million if the business is only worth $1 million. Well, it's suspicious.
That sounds like the plot for a true crime podcast.
Exactly. The insurance company wants to see tax returns, balance sheets, and business valuations to justify the coverage amount you're asking for.
And once the policy's in a drawer, are we done?
No. The source calls this the checkup. Business is dynamic. A policy that was perfect 5 years ago might be woefully inadequate today.
Because the business grew.
Or changed. Did you take on a new $3 million loan? Did the business value triple? If so, your buy-sell funding is now short by millions. If you don't update the policy, you're underinsured.
So how often should you look at it?
Every 2 to 3 years. Or anytime there's a major event, a merger, acquisition, key hire, or new debt.
It's maintenance. Just like you service the servers or the delivery trucks, you service your financial plan.
Precisely.
So, zooming out to wrap this up, we've covered a lot of ground key person, buy, sell, taxes. What's the main takeaway for you here?
For me, it redefines what crisis management means. We usually think of crisis management as PR spin or dealing with a lawsuit. But the death of a founder is the ultimate crisis. This tool converts that crisis from a business-ending event into a manageable transition.
It changes the narrative from the company is over to the company changes.
Yes, it empowers the succession plan. It forces you to have those hard conversations about the future while you are still here to lead them. It prevents the legacy from evaporating.
It's responsible leadership. even from beyond the grave.
That's the legacy.
I want to leave everyone with a provocative thought that really stuck with me during the reading. We obsess over growth. We measure our success by revenue and expansion. But try this thought experiment. If you stepped away from your business today, right now, and never came back, would it continue to grow, or would it slowly grind to a halt?
That is the ultimate litmus test.
The answer to that question tells you exactly how urgent this backup plan really is. Thanks for diving deep with us. Check your policies, make those plans, and we'll catch you on the next one.
Stay prepared.
That's it for today's Meet Sean. If this helped, follow the show and share this episode with one person who needs it. See you next time.